Hello, everyone. Welcome to the webinar today, Surviving the Hurricane with Michael Tyler from Eastern Bank. Grace will introduce him momentarily, but I just wanted to say welcome and hello, and thank you for being here. We always try to give you programming that will help your business be supported and give you the knowledge that you need to grow and to thrive. So here we are today, bringing you more important information so that you can do the things that you need to do to take your business to the next level. So a couple of housekeeping things. If you have questions during the webinar, please pop them in the Q&A box. If you go down to the bottom of your screen, there's a Q&A. You can pop your questions in there, and then we will either answer them as we go, or we will most likely answer them at the end of the presentation if they haven't been addressed during Michael's presentation. So here we are. Thank you again for joining today, and I will pass it to Grace.
Hello, everyone. Thank you so much for taking time out today. I hope you all have your sandwich and drink to have this lunch session. I'm super excited to introduce Michael Tyler. Michael is a very accomplished financial economist who has worked all over. You saw his credentials when we sent it out before. One of the things that I'm super excited about is that I got to watch this presentation recently at a board of directors meeting at Eastern Bank, where Mr. Tyler works as a chief investment officer and works with the wealth management folks over at Eastern Bank. When the CEO of Eastern Bank introduced Mike, he said, this is the one guy who can actually make economics sound interesting and understandable. And I was like, wow, coming from a head of a bank, that's a pretty big deal. And I was a little dubious that that would be so. But then I was entrenched in this, 20-minute conversation around how we should think about the current economic environment, because we all hear, depending on what news source you're reading, you're hearing it's dire, it's not so bad, it's going to be horrible, it's going to be fine. And, it was really good to hear all of the pieces of what Michael thinks is going to happen, and wanted to bring that to all of you. So super excited. You've read his credentials. He is, Harvard, Princeton, all over, incredible pedigree, but would love to introduce him now and have him teach us some stuff. So good to be here with all of you. Super excited about this, and I'll hand it over to Michael.
Okay, thank you, Grace, and thank you, Thais, and I'm delighted to be here. Welcome, good afternoon, and please do enjoy a good lunch. And I promise I'm not going to say anything that's going to make you choke. At least I hope not. So let me just tell you what I will talk about. The title is obviously a little tongue-in-cheek, but there's also a little truth to it, which is that we're sort of in this what's felt like a hurricane over the last year and a half, and maybe there's more to come, and maybe we're not. Are we at the eye of the hurricane now, where things are starting to resolve, but only to get worse, or are we pretty much past it and able to set ourselves into somewhat smoother going? Talk a little bit about the economy. I'll talk a little bit less about investing based on what's happening in the economy. And as Grace and Thais said, let's make sure that we have plenty of time for Q&A. So do use the chat or the Q&A functions, and which, by the way, I can't see, so I'm going to rely on you guys to let me know when I should stop talking or something. So here's the basic situation. This is what last year felt like, all right? We just got totally wiped out in so many ways. It was very painful for so many people. And we don't want your economic portfolio, either your business or your personal savings, to look like and feel like they've been smashed. And if you are feeling like this, we want to help you get it to rebuild again. And so just to put that in numbers a little bit, here's what last year did to us. I've grouped these different asset categories by whether they are cash or fixed income, bonds, in other words, or equities or stocks. And oil and gold, couple of commodities there. It was not a good year for anything. In fact, the last time that both stocks and bonds went down by so much was, get this, 1941. So this is beyond, I think, all of our lifetimes that we saw a year as bad last year. Normally, you would expect stocks and bonds to offset each other to some degree, and yet they didn't. And so we all felt a tremendous amount of pain. There was also some real perverse stuff happening. For example, what's the safest asset in the world? The one thing that if you put your money in, you know you're going to get your money back, it's a government bond. And yet, in terms of performance, long-term government bonds were the worst performing asset class of all last year. Now, you'll still get your $1,000 back if you put $1,000 in, but in the meantime, the price for it went down substantially. So this was just a really weird experience that we're all trying to come to grips with and figure out how to get out of. So this is what I call the market emotion cycle. Other people call it the emotional roller coaster. But markets go up and down. They're human creations, and we have emotions as people. They get reflected in markets as prices, right? So when you're feeling excited, when you're feeling optimistic, when you really think things are wonderful, you're probably going to pay a little more for something, whether that's Springsteen tickets or a house or shares of your favorite company. And when you're really absolutely despairing and thinking the world can't possibly get any worse, that's when you're going to say, glad Bruce is coming to town. I think I have to skip it this time. And by the way, we're not going to upgrade to a better large screen TV at home either. So that's, think about that. That's what drives prices in markets. It's all about emotion. So I've listed a few emotions, and I'll ask you to think about, where do you think the markets are? I'm going to come back to this at the very end, but think about which of these emotions do you think that we are? And then we'll talk about that and see what we think. Just to put it in context, this is just the stock market now. What I did was I looked at what rolling 12-month returns. So January to December, and then February to January, and then March to February, and so on, over the last 30 years. So there's 360 of those data points. And I positioned the January to December 2022 right there for the stock market. It was one of the worst over the last 30 years. So did this feel really bad? Yes. Was it really bad? Yes. Your feelings are accurate. It stank. In fact, there are only 6% of the time did the market produce a worse 12-month performance. Not good. But what happens when stock prices go down? That's an interesting question. Stocks are like any other asset, whether it's a car or shares in a company or a house or whatever else. It has some kind of value, and the underlying value, if you will, or a business for that matter, has an underlying value, which doesn't really change all that much from year to year, but the price people are willing to pay for it does. And so what you see when you buy stocks, what you're really buying is the earnings and cash flows of a company. And for most companies, the earnings and cash flows fluctuate from year to year, but not tremendously so. How much you're willing to pay for that earnings does, okay? So what we're tracking here is what happens after stock prices went down 10%, over the course of any period of time. Once stocks went down 10%, what happened 1 year later? Well, they were up 12.5% on average. Okay, this data goes back to 1926. It's almost 100 years worth of data here. So on average, a year after stocks are down 10%, they've recovered. So reason for optimism. Now, sometimes after a stock or a stock market is down 10%, it keeps going, right? Last year, stocks were down 10% by March, and they kept going down even further. On average, averaging in both the ups and downs, they're going to wind up around up 12%. But when they go down, they might go down 20% or 30%. Remember, in the 17 months from October 2007 to March 2009, stock prices went down 55%, lost more than half their value. So going down 10% doesn't mean that's all it's going to go. But once it does, it picks up. If it has gone down further, again, a year later, most of the time it comes back and gets you pretty close to where you started from. And the same is true, by the way, over 3 years and 5 years. So 3 years after stocks are down 10%, they're up about 35. And this makes sense because remember, the underlying value of what you're buying doesn't change all that frequently. So if you buy it at a cheaper price, you're probably going to get a better return. The reason, by the way, that these 30% drawdowns, when stock prices are down 30%, why those don't follow the same pattern of getting better and better over time, is that they incorporate the Great Depression when it took 25 years for stocks to recover their value. Let me just assure you, we are not in a Great Depression right now or anything even remotely resembling that. So right now, we finished last year in this yellow bar down 18 or 19%. Let's see what happens as we go forward, but statistics are in your favor. Let's talk about the economy, though, about what's actually happening out there. And I want to look, markets tend to look forwards, not backwards. So what you're buying today when you buy a share of stock is the future earnings of a company. So we're looking forward at leading indicators for the economy. And what we're seeing is that index, which is a composite of 12 different indicators, house prices, job openings, stock prices, and a few other things. I can't remember all of them off the top of my head. But you can see that they were running positive right up to the pandemic. They recovered pretty nicely after the initial. Okay, that was weird. I'm sorry, my network crashed unexpectedly, and let's pick up. I'm not sure how far I went before you lost me. So I'll just pick up here.
You were at the place where things got things got bad, and then they got good, and then you were going to tell us next, and we were all sitting here waiting, and then you stopped talking. So let's go there.
All right. So yeah. So the leading indicators definitely are telling us trouble is on the way. And I'm sorry that the network crashed there. Let's look at confidence. Confidence is simply a measure of how corporate executives, in this case, are thinking about the economy as you go forward. And what's interesting to me about that is that thinking translates into action. So here we're looking just at Massachusetts employers, and we're looking in red what they think of the Massachusetts economy, and in blue what they think of the U.S. economy. And for a long time, things, coming out of the big recession in 2009, it took a while for confidence to get better and better and better. And then, of course, it crashed right after the pandemic began, only to, again, improve. Right now, if you look at the far right edge of that, it's telling me that business executives are feeling nervous. They're not sure really whether they're optimistic or pessimistic. There's a lot of questions out there. And that suggests to me that they're going to be cautious about big expenditures. So I would suggest that businesses are not going to drive business here. They're not going to push for new sales. They're going to wait and see what the markets tell them, because so far there's not a whole lot of reason that they are feeling very excited. One way to look at that is what's called the Purchasing Managers Index. Now, these are people who actually spend money for corporations, and they're simply responding to a survey that asks them, are you spending more or are you spending less? What do you think about prices that you're paying? What do you think about your ability to hire new people? So in orange are manufacturing companies, in blue are services companies. The green line is simply a neutral rating. It's an index. You're above the green line, you're feeling optimistic and growing your business. You're below the green line, you're pulling in your horns and being very careful. Well, from pretty much July of 2020, not far into the pandemic, people started seeing recovery and feeling pretty good. And then again, as with the leading indicators, for a lot of the last year, people have been very nervous and scared and pulling in their horns. Note the uptick in the last month or so in both manufacturing and services. If you're looking for gleams of optimism, or what somebody once called green shoots, there's one of them. So there's hope there that things are going to be improving. Consumers are telling an, interestingly enough, similar story. So consumer confidence, it's just a survey that the University of Michigan takes each month and tracks. The numbers on the left really don't actually mean anything. It's what you're really looking at is the shape of the picture more than anything else. And what consumers are telling us is that sometime in the middle of last year, they were feeling worse than they were during the housing crisis and Great Recession more than 10 years ago. And that's pretty extraordinary to me. They're feeling worse than they were at the peak of the pandemic when everything was shut down. They're feeling a lot worse than that now. And so what's driving that? Why are consumers so scared right now? I think a lot of it had to do with all the messaging about inflation that was happening last year, waiting for recession that so far hasn't come. And consumers are starting now to feel a little bit better. So I'm feeling a little bit better about consumers, but more to say on that. And here's why. Consumer spending is a pretty good metric also. And this is now not survey data. This is real money that we're talking about. And those are millions of dollars on the left. So consumer spending has gone from $300 billion about 10 years ago, a little more than 10 years ago, to more than $500 billion now. And you can see that it was growing very steadily at about 3 or 4% a year for most of the last decade until the pandemic happened, and all of a sudden nobody could spend money on anything, so consumer spending went way down. And then eventually we started getting money from the government, a lot of support, whether it was payroll protection or the CARES Act or all those things that came out. And as the economy started to reopen, we started spending money again, and we got a lot of government support, so we spent more money. And you can see that retail sales took off like a rocket and have remained much higher than they would have been. And that's what the red line is sort of, if the pandemic never happened, where might we be with retail sales? We're way over that. So consumers are spending way more than the economy ordinarily would support. That's a troubling sign. That suggests that maybe consumers are a little too excited, a little too happy right now. And if so, then we might want to be a little nervous that that spending is going to start coming in. And here's another way to look at it. I'm sorry it's a messy chart, but that's part of the point. The green line is consumer income, how much money we take in every month. It includes everything. It includes government support, it includes your paycheck, it includes anything. The red line is how much money we're spending, again, on anything. And you can see that right up until the beginning of the pandemic, we were spending about as much as we were taking in, more or less. So, it's not a perfect correlation, but it's pretty close. Pandemic comes along, we stop spending, the red line goes below the chart. Income keeps coming in from the government, so the green line goes way up. And you can see each of those spikes in the green lines related to another government program. Eventually, though, as the economy reopens, you can see that spending does come back very strong, off the charts high, actually, roughly speaking, 2021, when we were really in the flower of reopening. And then spending has been slowing down as our incomes, well, we lost a lot of government support, right? A lot of the government programs went away. And now what we're earning is coming from actually earning, not being given through our paychecks more than through government support. I want to see those two numbers coming together pretty steadily. And ideally, I'd like to see them at around 3 or 4% where they were before, not at 7 or 8%. So the consumer still has some retrenchment left to go. They're spending, all of us consumers are spending more than we're taking in. And what we're taking in is still a little bit kind of reflecting the afterglow of government money. That's got to come down back to the real world of how much you actually bring in with your paycheck. Meanwhile, look at spending, look at savings, how much money we're saving. And you can see that it went way up when we had nothing to buy. and then has come way down when we started spending money. In fact, the savings rate now is lower than it was over the past 10 years before the pandemic. That's a little worrisome because it means that, in fact, we're probably borrowing more money now and leveraging our spending. So we are not only spending too much money, we're doing it with money we don't have. And that's a problem. And you can see that our debt service, how much money we're paying in interest on our credit cards, student loans, car loans, house loans, you name it, is going back up. And this is a little bit more scary than it looks, because remember, interest rates have been pretty low. And this is looking at dollars. Okay, how much of our income in dollars are we spending? When interest rates go up, this number can get a lot higher. In fact, the absolute amount of debt that we have is a lot higher than you might think, or than this chart shows. So consumers, I'd say on average, a little bit of stress is starting to show up, and that's a little bit concerning. Mortgage rates, we all know this, it's in the paper every day, right? How much mortgage rates have just shot up. It's even higher, it's back almost to 7% just in the last couple of weeks since I updated this chart. And so that's making it a lot harder. Many people, probably most homeowners, understood low interest rates when they saw them and locked in low long-term rates. So the installed base, if you will, of homeowners probably aren't worried about this. But if you're buying a new house, or if you have an adjustable rate mortgage, then you're going to look at this chart and get very nervous. And so that does have a chilling effect on homes, and home sales are a major driver of economic growth. And this is what home starts are looking like. Starts is another way of saying construction. So what we're seeing, this chart goes back a dozen years or so, and you can see that it's been home starts, home construction was building pretty steadily for a long time. Took a bit of a nosedive during the pandemic. That was hardly surprising. And then it recovered very, very nicely until about the middle of last year, at which point it really started slowing down. And this does cause slower economic growth. This is a big deal, that home starts have gone down from about 1.7 million a year to about 1.5 million a year. That actually does have a big impact on the economy. The colors of the chart, by the way, simply differentiate the regions of the country. The Northeast, where we all are, oh boy, that's just flatlined. We are not building homes in the Northeast. Most new home construction is happening in the South. And when you think about that from a business perspective, what's that telling you is a lot of your best talent is moving to Florida and Texas because they can afford to buy a house there. There's a house for them to buy, and they can afford it, and the cost of living is lower. And we are losing talent as a region. We are losing talent to the South, and to a lesser degree to the far West. And it is largely because prices here are expensive. We're not building new homes. There's not a lot of places to buy. The infrastructure isn't adequate. These are big issues that government has to work on. Another way to look at that annual, where was I? This chart shows you the absolute number of housing starts coming down. This picture shows you how rapidly that has been. So the number of housing starts, this is driving a real concern in the economy. Okay, so again, thinking about the economy overall slowing down, businesses more cautious, consumers a little bit over leveraged, not red flag zone, but definitely a little over leveraged. And by the way, fewer houses to buy. This is becoming a problem. Inventories are very low in the housing market. So not only are they not building new stuff, but you can't find existing housing either. That's a real problem. That's a major reason that we have a lot of issues around housing in this country. Okay, let's look at the job market for a few minutes. Complicated chart here, I suppose. This is not percents, this is actual numbers of people. In the green is the number of unemployed people in the country, people who are actively looking for work. In the yellow are the number of job openings that companies have posted. And you can see that through most of the past 10 years, and really for most of American history, there are more people looking for jobs than there are jobs to be had. That's sort of the nature of things. But in the last several years, since the pandemic really got underway, it's been exactly the opposite. And now we're seeing that there are almost 2 job openings out there for every 1 person looking for work. And not only that, but a lot of the people looking for work don't have the skills that those job openings require. So there is something of a labor shortage happening right now. The quits rate in red is kind of the indication of that. And that is people who voluntarily leave one job to get another one. And that's sitting not quite at record highs, but it's pretty high compared to its history. What does all that mean? Well, one thing it means is let's look at annual change again, okay? So this is the absolute number of job openings, very high, but you can see it's kind of stabilized and maybe even drifted down a little bit. This is the degree to which it has drifted down. It is stalled. So a lot of those job openings that you see here are stale. They're just out there, but they haven't been filled. Maybe they're being filled, maybe they're not. It's not exactly the highest priority to add staff. And if, go back to those confidence numbers, if you're a CFO and you're a little bit nervous, you may have that job opening posted, but you may not be all that excited to fill it. That's what this is telling me, is that don't rely too much on the idea that there's a lot of job openings. It's more complicated than that. But at the same time, there's still a mismatch. Part of the reason for that mismatch is that we are seeing people left the workforce. Now, labor force participation, that just means the people who are working plus the people who are looking for work divided by the total number of people over age 16. That's how you calculate that number. And you can see that up until the pandemic, it was running around 63-ish%, more or less, so 63.5%. And it's dropped during the pandemic and only slowly begun to come back and then flatlined. So people left the workforce and they didn't come back. And who left the workforce? Mostly white collar, mostly older, mostly people in their 50s and 60s, high up in the company structure, lots of skills, lots of credentials, hard to replace. And so we're seeing a substantial problem there. That's part of the reason that companies can't fill their jobs, is that people just aren't taking them anymore. Having said that, what do you do if you're a company and you really do need to hire people? Is you pay more money for it. So the green section just shows you the average hourly wages. You can see during the pandemic, it really popped up a little bit and then kind of leveled back off. That was really a function, honestly, of who got laid off during the pandemic and who kept their jobs. Namely, a lot of upper income white collar workers kept their jobs. A lot of lower income blue collar people were laid off during the pandemic. So the kind of average mix, if you will, skewed higher. Soon as people started reopening and getting back to normal, that went away and the trend continued. But we are still looking at about 4.5% average annual wage increases. Now, wages are a very large part of the cost structure of most companies, including, I'd say, most of us here today. And so you can't really get from 4.5% wage price increases to 2% overall consumer inflation unless you take a hit to your profit margins, in which case your value is going to come under some pressure. So that's when you hear the Fed talking about inflationary pressures, wages is a big one, and you don't want to see a wage price spiral. Right now, wages are growing slower than inflation, which is good, but higher than where inflation needs to go, and that's not so good. And this is what inflation looks like overall. The orange line, very volatile. That's producer prices. Commodities go into that, all sorts of other stuff. I don't pay too much attention to it. It's not really good as a leading indicator. The purple line is overall consumer prices. That's also somewhat volatile. A lot of things like food and energy and other things can be fairly volatile. So we pay attention, but it's not the highest priority. For me, it's that yellow line. It's the core inflation, which excludes food and energy. And you can see that it's gone up after years and years and years at 2%. It's gone up and up and up. Why? Because all of a sudden we started spending money that we didn't have, government handouts that we started spending, and that retail sales went way up, and the American economy wasn't really geared to produce that quickly. And so supply demand shortages came into play, along with supply chains and other issues as well. And that has stayed stubbornly high. And I'm going to show you why it has stayed stubbornly high, because I think that's relevant. Before I do, just one quick comment on money supply. A lot of people in the economics world believe that inflation is simply a function of money supply. And you can see here, going back to the days of the financial crisis, that money supply grew at about a 2% annual rate for a very long time. And guess what? Inflation was around 2% for a very long time. So all those economists who think that money supply and inflation are exactly the same thing, well, they're sitting smug and happy. And then all of a sudden, during the pandemic, the Fed increased the money supply by 40%, 40%, over the course of about 18 months. That was absurdly high. Again, that was to finance all of those government handout programs that were, frankly, did a lot of good, right? They kept people afloat during a very serious pandemic and a very serious economic crisis. So don't mistake me for saying that they were a dumb idea, but they did distort the economy. And one thing that they did is they increased the money supply very greatly. And so again, the red line, what if there's no pandemic? What's going to happen? Sooner or later, the red line and this green line do have to converge. We do need to see the money supply coming down. It is coming down. If you look over the last few months, the money supply has come down a little bit. That's because the Fed stopped buying bonds. That's a really good thing. This is actually the last time that the money supply came down that much. Believe it or not, goes all the way back to the Depression. It's very unusual. And frankly, it's a good thing right now. We need to see something like this happening. It will help inflation come down. It's not the only thing. But here's what's going on with why inflation is staying stubbornly high. So on the left side in yellow is what the inflation rates were for a few key pieces of the economy a year ago. And then in purple, where they are more or less now. I haven't updated the slide in a couple months, but it's basically the same numbers. And you can see energy, gas prices, right, was shot through the roof in 2021. New car and used car prices shot through the roof because there was no supply of new cars. Those are very volatile, and they do come down, and they did come down. So the purple figures for the current year, much lower inflation rates in those areas. But look at the right side. This is contributions. So this is looking at 7% inflation overall in December of 2021. Where'd that come from? Well, half of it was just from those two areas. They're not big areas, but because these were such extreme levels, it had a big impact. Now look at what I've circled here, shelter. The rate of change in housing prices and rent prices wasn't very high in 2021. It's not very high in 2022. But it is accelerating, it is growing, and shelter is a big piece of the index. So energy and vehicles together are about 10 or 11% of the basket that the government uses to calculate inflation. Shelter all by itself is 1/3 of that index. And so small changes in rent prices lead to huge changes in inflation. And by the way, this sort of gray area, all else, that is mostly consumer services, healthcare, accountants, teachers, lawyers, you name it. And as those prices, i.e. wages, have gone up, guess what? That has had a huge impact on inflation. And what's the problem with all this? It's that gas prices come down, car prices come down, rents generally don't come down, and the hourly rates that lawyers and accountants and teachers and whatnot get paid, they don't come down. So it's a much stickier inflation now than was the case a year ago. And that's what the Fed's problem is going to be. Interestingly enough, the market doesn't really care. And I find this fascinating. This is what you do is you look at treasury prices for 10-year bonds, 5-year bonds, 15-year bonds, and so on. And through some arithmetic, you can derive what the market thinks inflation rates are going to be based on treasury bond prices. And so the blue line's where inflation actually is. The red line is where people think inflation's going to be 10 years from now. And the answer is they think that over 10 years, it's going to come back to 2.5%. I sure hope so, but I'd like it to be a lot less than 10 years. And that's not yet known. So to quickly summarize, and then I'm going to wrap up the rest of it in maybe 5 minutes. The economy, right now we have much higher interest rates, and that is to combat inflation. And the Fed just yesterday and on Tuesday, Fed Chairman Powell in Congress was saying, by the way, we're going to raise rates even more than we thought because inflation isn't coming down fast enough. So the Fed is committed to what I call higher for longer, higher interest rates and for a longer period of time to push inflation down. Will that lead to a recession? Because more expensive borrowing means that you're not going to borrow as much. Housing prices are under pressure. Housing construction's under pressure. You're starting to see it filter into the real economy. Purchasing managers don't buy as much when the cost of buying things is more expensive. So we are seeing a slower economy, no question about it. The challenge that the Fed has is the job market strong enough to enable a soft landing, a non-recession endpoint? Or, as I showed you with a couple of pictures, is that job strength a bit illusory and maybe we are going to have a real recession? I kind of think we're headed toward a real recession, but not a very steep or severe one. But still a mild recession is a recession. So quickly talking about the markets right now and what you do about that. This is what's called a yield curve. You may have seen these, and it simply says for government bonds, government debt, right? The government has maturities overnight to 1 month, let's say, treasury bills, 10-year treasury notes, 30-year treasury bonds, and so on. And this is just the interest rate at a point in time. And you can start in the yellow. That's, again, a little over a year ago, what the interest rates were. So a 30-year treasury a year ago was at 1.8%, and overnight was about 0. Today is this red line. What do you see? Two things about this red line immediately. One is a lot higher everywhere. Interest rates have gone up everywhere, and that's already had a big impact. Now, understand an interest rate or any other yield is directly and inversely related to price, right? So think about it. A $3 dividend on a $100 stock, that's a 3% yield. If you want a 4% yield, well, one way to do that is to raise the dividend. Let's assume the dividend is static at $3. $3 is 4% of something like 80 bucks or something. I can't do the arithmetic in my head, unfortunately. So higher yield automatically means lower prices. And so when you look at what's going on here, these higher yields that you're seeing today indicate much lower bond prices. And by the way, the longer the maturity, the more significant that impact is. For example, when a 30-year treasury, and this is what I showed you right at the beginning, went from 1.8 to 3.8%, 2 percentage point increase, it had a 35% impact on the price. Again, sooner or later, you'll get paid in full, but in the meantime, it's very painful. From a bank's perspective, and you know, Grace saw these slides because I used them at the board of advisors for the bank. A bank's costs are deposits, how much they have to pay out to get people to give them money. Their revenues are mortgages and commercial loans. So bank profits are under some pressure when you see revenues going up, but costs going up a lot more. Now, this is what the Fed is telling us. This is the so-called dot plot. There are 19, I think, or 16 members of the Federal Open Market Committee, which is the group that sets interest rates. And each one of them gets one dot of each color that I put there to show where they think interest rates are going to be at the end of this year, the end of next year, the end of 2 years from now, and kind of longer term, and where that rate is right now. And you can, and actually in the last few weeks, it's popped up a little bit. It's one notch higher. But the Fed overall thinks that interest rates are going up this year. And I bet when this was from December, they're going to republish it in 2 weeks on March 22nd. I guarantee you There are going to be a couple of people all the way up at 6%. And sort of the emphasis is going to be more around 5.5 to 5 3/4. So rates are going up. Next year, nobody has a clue. When you see one Fed person saying it's going to be down at 3% and another saying it's going to be up at close to 6, the Fed really has no idea what's going to happen next year, but probably lower. At some point next year, we'll start seeing rate cuts. 2 years from now, almost certainly. Long term, sure. So everything that's gone down in price because interest rates went up, probably you're going to start seeing improving in price as interest rates come down. The question is when and by how much, and the Fed doesn't know. And by the way, just because they control interest rates doesn't mean they know what they're going to do. They don't. Credit spreads is simply a measure of how investors think about corporate bonds versus government bonds. And this is just subtracting one interest rate from another. So when you look at corporates, investment grade, good quality companies in green, or lesser quality companies in orange here, you'd expect to pay a little bit higher interest or require a little higher interest rate because there's a little more risk in a corporate bond than there is in a government bond. But this is telling us that investors aren't really very concerned about that right now. These numbers are pretty low. And so the market's telling us that, gee, we're not really too worried about interest rates. We're not too worried about the overall economy or the effect on companies. And that's a positive sign. Looking at stock prices here, this is a long chart. This goes back 25 years. The green line is just the price of the stock market. The red line is the earnings that you're buying, and they're set so that those lines cross at a multiple of 16 times earnings. And why? Because over history, that's about what the average has been. So what we're seeing here is that, gee, for most of the period during the pandemic, prices went up much faster than earnings. People were getting too excited. And of course, over the course of the last year, as interest rates went up, prices came down. Now earnings are coming down a little bit. So the market is kind of saying we've adjusted. We understand that we might be going into a recession. And you can see that in the price to earnings ratio has come back toward its more traditional long-term average. Overall, stocks and bonds have a relationship with each other. And what I'm showing you here is that typically the yield on bonds, historically, this goes back to the 1950s, historically is higher than the yield on stocks. But over the last 10 years or so, it's kind of been about average. They've been about the same. So let's take this bottom right corner of this chart and move it forward. Same chart. All I did was blow up the bottom right corner. And again, the red line is bond yields. You'd normally expect bond yields to be higher than stock yields. When stock yields were a lot lower than bond yields, when stock yields were higher than bond yields, which I've circled in yellow, you were getting both higher current income and more growth in stocks than bonds. Fabulous time to buy stocks. Every one of those were a great time in history to buy stocks. However, right now we're seeing that stocks are actually kind of fairly priced against bonds because you'd expect about a 2 percentage point difference in the yields. This is telling me that stocks aren't really cheap compared to bonds. And so where are we in the market emotion cycle? We're somewhere on the bottom left. I don't know exactly where, and you may feel very differently, to be honest. Have we finally just given up and things are actually starting to look good? Have we just given up and things are continuing to get worse? Are we starting to see green shoots? I'd say no. We're not yet at the point where we can say the economy is definitely on an upturn, but we are definitely past the point of panic. I mean, last year was the panic time. Now we're struggling to find that bottom. We're struggling to figure out when it's time to start becoming more optimistic. And historically, this is a great time to buy financial assets. It may take some time before it really translates into action. You don't want to be too picky or smart about trying to time the market, but I think that there's more upside than downside right now, even if we're heading into a recession, as I think is likely. So to survive that hurricane, follow the Fed. The Fed is right now getting to the end of its cycle. So yeah, the Fed is still going to keep raising rates more than we thought, but it's also most of the way finished. You know, going from 0 to 4 3/4 so far, if your high point is 6, you're 2/3, 3/4 of the way through. You've already felt the most pain. So both stocks and bonds are looking a lot more attractive than they were. Stocks don't especially look great compared to bonds, and there's still a lot of risk in the economy. We're not going to try to predict everything perfectly because we can't and nobody else can either. So what you try to do is build a portfolio that's diversified, that's resilient, that you rebalance regularly, and you stick to your discipline. Over the long term, you're going to be okay. Let me just leave you with 2 final tidbits. The Super Bowl indicator gets a lot of press. It says that when an original National Football League team wins the Super Bowl, stock prices go up. And when an original American Football League team wins the Super Bowl, stock prices go down. This is such a simple rule, and yet and seemingly irrelevant, and yet it's right 3/4 of the time. Better than me or any other stock picker out there. It's incredible that it still works. And unfortunately, the Chiefs won the Super Bowl, which means we're looking at a bear market for this year. So I don't know if this is really going to happen. You know, it's all tongue in cheek, obviously. But let me just give you another one, which is the presidential cycle, which says if you simply look at the actual performance of the stock market in the first year of a president's term, second year, third year, fourth year, and so on, year 3 is the big year for stock markets historically. And this goes back again to 1926. So read into it what you will. Maybe this is going to be a good year. It's going to be a bumpy and challenging year. When you have a few minutes, we'll send you the slides. You got to read these disclosures just so that you know that we're being honest. And with that, I'm going to pull down the pictures, and we've probably got 10 or 15 minutes for questions. So Thais, I'll turn it to you to kind of run that.
Michael, thank you so much. This was truly a great presentation. I really appreciate that you were willing to come over and share this with our members and with our staff. Thank you. We do have a question in the Q&A box from Lisa. So when you spoke of skilled workers heading south, what is the impact of remote work having on those numbers? So what's
yeah. What a great question. The answer is it's unclear, but it's not good. And what I mean by that is that workers mostly have felt during the pandemic that they could work anywhere. And in fact, that's exactly what they wound up doing. And so the jobs, in many cases, if you look at the jobs numbers in Massachusetts, for example, you look at the employment numbers against the residential numbers, it's clear that a lot of people work in Massachusetts but live elsewhere. That's been going on for decades, right? That's why Nashua, New Hampshire is a pretty interesting place, because I mean, it's gotten a lot of and so that's not by itself surprising. It accelerated a lot during the pandemic. It has big implications for tax revenues for the Commonwealth, but also for New Hampshire, Maine, Connecticut, wherever else. And it means that when I have a person on my team who lives in Arizona, say, or California or whatever, if we can work very well together, then why do I need them to be in Massachusetts for? There are many jobs where in-person is important. And what we're seeing is companies are beginning to call back their people and say, no, you really do need to be in the office. And other companies are basically saying, it's working. Don't break it if it, don't fix it if it ain't broken. And so these are all, but I think what's happening is that Massachusetts-based companies are probably going to continue finding more people who are good talent in other parts of the country. And they may still technically have a Boston-based job, even if they're in Austin or Tulsa or wherever. What does that mean? It means Massachusetts companies are probably okay, but the folks on Beacon Hill are not going to be happy because their tax revenues stink. And not only that, but the Sweetgreens down the block from my office, they're not happy because the lines out the door are no longer at the door. Because I'm not buying my lunch at Sweetgreen, I'm buying it somewhere else. And so you see Sweetgreens, to use one simple example, is now opening new locations in residential areas, in the suburbs, not in the downtown core where they used to be. And the line at the Sweetgreen on Franklin Street is way, way, way less than it ever was. And so they have to open in Wellesley, they have to open up, in other suburbs. That, I think, is changing the structure of the economy in a lot of ways that we haven't quite all figured out. But the underlying core, I think, is that we're going to see more people living in the South and working in Massachusetts. And if those Massachusetts companies say, gee, I think you really might want to be in the office, interesting dynamic. Wouldn't surprise me if a lot of those people in Austin say, gee, thanks, but no, I'm going to join this other company in Austin, and then we've lost them forever. That's, I think, the real challenge that is kind of hiding behind all this.
Thank you so much. It's interesting. I was having this conversation this morning about some of the larger employers that sort of drive the decisions around these things, right? When the really large employers say, oh, oops, wait, we need people to come back into the office for 2 days or 3 days a week, but people moved away. What does that mean generally for the landscape? And we landed where you landed too, which is, people are away, and if they get pushed to do something that is not feasible or is not seen as beneficial, then we're going to end up losing good talent. So really interesting question. Thank you, Lisa. And then on the business side, interestingly, also had a conversation with one of our businesses that is going through that exact thing. They had a coffee shop. One of their coffee shops was downtown, and business is way down, and they're trying to figure out where to open a different location to. So yeah, on the nose there. Let's see. What do you anticipate the fight over the debt limit, the debt ceiling, will do to the economy?
Oh boy, how many hours do I have to rant about this? Because the debt ceiling is 100% pure theater. There is absolutely no substance behind it, or at least there shouldn't be. The US and Denmark are the only two countries, major countries, that have a debt ceiling. Every other country in the world has figured out that markets set debt ceilings, right? The price that investors are willing to pay to buy government bonds will set how much money the government is able or willing to borrow. And we don't do it that way. So it's an artificial thing, first of all. Secondly, if we breach that, if we default, if Treasury stops paying its bills, the impact will be huge. And it will be huge in so many different ways. Markets, every major securities market in the world fundamentally hinges on US dollars. And why is that? Because there's something called the risk-free rate, the interest you get paid based on absolute certainty of knowing you get your money back, right? So you buy a Treasury bond, you know you're going to get your money back. And so whatever interest rate is purely about the time value of money. Every other security, whether it's a bond or a note or a debt obligation or a stock price or anything else, is a combination of that risk-free rate plus some kind of premium rate that relates to the risk that you're taking for that you might not get your money back. And so if all of a sudden the risk-free rate is no longer risk-free because you might not get paid, it's going to throw the US and global securities markets into a complete freak out. I don't want to say tailspin, because I don't know that it's necessarily going to drive prices down, but it's going to make prices really wacko for a while in whatever direction, and nobody's going to really know. It also means, now let's think about what suppose that the government decides that they want to avoid that, so they're going to pay just their bonds, but they're going to stiff Social Security, or they're going to stiff Medicare, or they're going to close the national parks. Well, every one of those has huge implications. Social Security payments are $100 billion a month. Medicare, $60 billion a month that goes into the economy. You take that out of consumers' pockets, and they're in a real hardship situation. And you're going to see that translate not just into a lot fewer sweet green meals, but a lot less consumer spending on a million other things too, which then causes all of those suppliers and all those companies to have severe problems. So the impact of a debt default, whether it's on the debt itself or on other government obligations, is huge. It is utterly unnecessary, but it would happen. And so when you think about playing a game of chicken here, I sure hope that they figure out a way to resolve that debt ceiling. Now, one possible way, honestly, is to ignore it, is for the Congress, if they don't raise the debt ceiling, the government treasury might say, well, we're going to spend the money anyway, come catch us. And there's no mechanism in place that will require the treasury to stop spending money. So you might get a long drawn out court thing going on too, which might make matters even more crazy. So the short answer is, please, let's not go there. Let's hope Congress gets its act together and either abolishes the debt ceiling or just raises it and gets out of the way.
Thank you so much. And one last question. So similar question to the real estate and tax implications of VRBO Airbnb. How are these short-term rentals impacting negatively or positively?
Impacting what? I'm going to assume you mean impacting the state's financials. And the answer is yeah. If I can, as a consumer, rent a quote unquote hotel room for $100 a night versus a more or less similar room for $200 a night plus 14% tax or whatever the tax numbers are, then Airbnb looks a whole lot more attractive. And they've taken a tremendous market share away from the hotels and away from that. Those tax dollars disappear from the government. And so government revenues start going down as more business goes from Marriott to Airbnb. And I think that dynamic underlies something that blue state governments don't understand. And I see this in so many places. They assume that, and you see this frankly in what President Biden is suggesting in his budget too. You assume that if you raise taxes, people are going to pay their taxes and everybody's going to be happy, and now you can fund all sorts of government programs. What happens if you raise taxes in the real world is it affects how people spend money. Instead of going to Marriott and paying your 14 or 20 something percent hotel tax, you go to Airbnb and you pay a lot less. And if you're in a state that has a very high income tax, you might, and they want to raise it, or if they want to do a surtax on your high income, you might move from San Francisco to Tahoe City in Nevada, or you might move from Boston to Nashua, or you might move from New York to Bermuda, whatever, or to Florida, right? So part of the reason that there is a big outflow of people from New York and Massachusetts to the South, California lost a House seat for the first time in its history this past census. Its population is going down. Why? Because people are leaving, and it's in part because money moves faster than government. You raise taxes, people leave. And that's something that I think the question about Airbnb, I didn't mean to really get into a rant about this, but it does suggest that blue state legislatures in particular need to understand that just because you raise the tax rate doesn't mean you're raising revenues. You may actually be reducing revenues by influencing people to leave.
Thank you so much. Any other quick questions, folks? Otherwise, we will wrap up. I'm gonna just as we give you another chance to pop a question into the Q&A box. Thank you, Michael, again for being here today. Thank you for sharing this really informative and fantastic presentation with our members and with our staff. And I don't see anything else in the Q&A. So thank you, members, for joining today. Thank you, Michael, again. and we hope to see you all soon.
Thank you all for having me. It's great to talk with you.
Thank you so much.